Wait, what? I can do that? This is Eric Bell with Wait, What? Financial matters that matter for business and the people that own them. This episode is called Protect, Profit, and Preserve, and I have Bob Spatafor and Jay Stobaugh with us. I was wondering, guys, can you give me a little bit of background and tell me how you got into this business, into the protection business?
Well, I've been at this for quite a long time. I've been in the insurance industry for over 30 years. Started out on working with corporate America with Allstate, and then I opened up my own independent agency and had doing commercial and personal lines of business for 20 years. Sold it about 14 years ago and got into what we call the alternative risk market, where we can create custom plans for businesses to insure risk, either through the captive world or in the excess and surplus world, which is where we fall into it. And it's kind of, I find it quite interesting because in the normal insurance world, it's cookie cutter. With this, it's customized specifically for the business.
I kind of took a different path. I have been in the claims risk management side for 30 plus years. In that 30 years, I held senior positions in the third party administrative role, companies in North America. And then I spent a number of years in senior management role with a large carrier here in the U.S., designing risk management and claims programs, and been in the alternative risk program business for a little over 15 years in designing and working with clients to take a look at those risks that traditionally have not been able to been underwritten in the traditional insurance market.
Okay. I was talking to my producer, Brian, and I was telling him about the unique offering you guys have. In my mind, it's a big difference between the captive insurance companies that are out there. I was wondering, can we talk about Apex now and give us some history and around the structure and the market and value proposition in terms of Apex?
Sure. Apex, it's not a captive. It's not an 831B, which right now in the industry, 831Bs are having a tough time navigating the choppy waters that are out there. We're a true excess and surplus insurance company. What's unique about it is we can, similar to what you do in a captive, we can write risks that aren't available in the standard commercial market. No commercial insurance company wants to write any risk that will cover losses in business revenue. So mainly what we concentrate on, which is what keeps business owners up at night, are threats to their revenue stream.
Okay. What type of risk does this work best for to solve?
There really is no best for, Eric. It's any business, be it a doctor, IT, real estate investor. There really isn't a business that someone owns that would be totally immunized from risk to their revenue stream. If you go to dinner with any business owner and just simply ask them, what keeps you up at night sometimes that you worry about your business moving forward into the future? And most of the things they'll tell you about will revolve around things happening to affect their earning, the business income. So we can insure against not all of the risks. Some of them are the cost of doing business. But for an example, if you've got a doctor, all doctors carry medical malpractice insurance. But if a doctor is sued under their medical malpractice policy, they're fine on that policy for expert witnesses, attorney fees. If they happen to lose, the cost of the settlement. But if it's a fraudulent case and it gets tossed out, but it happens to make the papers, they now have a ding to their reputation. Their medical malpractice insurance won't cover if their business drops 30% because word of mouth, they should stop going there. We offer a coverage, reputational risk. So if something like that were to happen and their business dips, there's a possibility for them to file a claim to help offset that loss.
So you're covering reputation risk. That's a big one.
It is. If you're in a rural area, we're in Texas, you get somebody who's in a rural area where 70% of their business is word of mouth. If something like this were to happen, it can be quite devastating to their business.
So you talked about doctors and lawyers. Who does this make sense for? What type of businesses or business owners?
Any business owner. We've done everything from persons that own car dealerships. We've got a gentleman that has a franchise with making pizzas. He's got 11 units. Things that we cover for him, he thought he had all the coverage in the world. And I asked him, I said, well, what happens if tomorrow you walk into one of your units and the pizza oven doesn't work? wasn't hit by lightning. There wasn't water damage. Nobody walked in and stole it. So he doesn't have a commercial claim. And he goes, well, I'd have to buy a new pizza oven. And I said, well, how much does a pizza oven cost? He's around $48,000. I said, okay. And how long does that pizza oven take to come in? And how long does it take to have it installed and up and running? And he says, well, typically 7 to 10 days. And I said, well, now you're out revenue because you couldn't make pizzas out of that unit for 7 to 10 days. Is that something that concerns you? Of course, in that market, if you're out of business for 7 to 10 days, that's a lot of revenue. And that's also a risk that we write, like equipment breakdown in the restaurant business. So there's no business that's immune to these types of losses, and we customize them to fit that particular business, whatever it would be.
When I think about commercial insurance, I'm thinking, about Allstate, State Farm, some of the other individual type of insurance. But when I think about commercial insurance, I think about Marsh and some of the big carriers, but they're covering like E&O insurance. They're covering like workers' comp. You're covering things that are traditionally not within their basket, things that are outside of their basket. Is that correct?
That is correct. And in fact, a good example to use, Eric, even in your own, whether it be commercial insurance or whether it's your auto homeowners insurance, every time you get a renewal, there's usually a supplement in there that tells you what is now being excluded. Think of insurance. I always use a Swiss cheese analogy. When you see a wheel of Swiss cheese, you think everything's just perfect and fine. But when you cut that wheel in half, there's a boatload of holes in there. Your insurance policies are like that. We go in and we find those holes where it connects with your business where you have a concern, and we fill those voids in. We never replace what's available on the commercial market.
Can we take a step back, and can you give me some history on Apex and the structure?
Yes. Apex has been in operation since 2011. As I said, it operates as a true excess and surplus insurance company, so there's no reporting requirements like you run into in the captive 831B world. We're based out of Bermuda. We're in with Randall Quilter. Randall Quilter is a publicly traded company on the London Stock Exchange, and our policies are underwritten by Marsh, which is the largest reinsurance company in the world now. They took over the number one seat probably about a year and a half ago. So everything is underwritten like any other excess and surplus. Excess and surplus is, if you're not familiar with it, I had an insurance agency for 20 years and represented 20 companies. But you always run into risks that none of your 20 companies want to touch. So we would have to go into the excess and surplus market through an excess and surplus broker to find a company that could write the risk. Most companies are not large enough to go to Lloyd's or the Marshes of this world and have something custom designed for them. You can only do that if you're in like an annual premium base of like the $5 to $7 million range. Apex really acts for that business owner who's not large enough to enter into the customization of risk management and allows them to customize risk for their business with a much more, an annual premium total. We can go down as low as $250,000 a year, where you can't do that in the traditional excess and surplus to get something customized for you.
And Bob, you guys insured one of my franchise owners, and I was kind of surprised at the ease of the process and how it was all automated through the computer system. Can you talk a little bit about that?
This is Jay, Eric. We have a website, apexexcessandsurplus.com, and that's really what we've tried to work with from an IT and simplifying the process, trying to walk through it at 32,000 feet. We work with a client. We sit down initially over the phone, webinars, what have you, with the client, and there is a form that they need to complete that will give a high-level overview of the client's company and, in particular, risks that might be the client might have. We take it a step further in another call with the client and reviewing the materials and doing kind of a deeper dive into making sure that we, from an Apex side, understand the client's business and concerns around risk and design that program. It's all online, so you can submit the questionnaire along with client's financials, and that is at a high level. It goes into our system. It goes down to Randall and Quilter, who do the initial underwriting analysis, and comes back with a summary of what they feel based upon the information provided provided in the forms, the financials, and our review. They come back with a snapshot or a summary of what they believe are the true risks that the client has that can be written in the Apex Excess and Surplus program. Again, that's all online. It's about a 48-hour turnaround time. And then we go back to the client and talk about what's come back from an actuary standpoint, get the client's perspective on it, their buy-in, and then it's just a simple process of moving forward and binding the coverages, their annual, yearly policies. So, all in all, the process is anywhere from 48 to 72 hours from start to finish. So it's very, very easy, and it can be all done online through our website.
And from the client basis, the stuff that's happening behind the scenes, we like to have a 5 to 10 minute conversation with them. They probably would need to spend 5 to 10 minutes maximum through our website to start the application process, which would then generate that proposal that Jay's speaking of. And once we get the okay that they're ready to move ahead, it's a simple and painless process they're not even aware of, and they can submit their premiums online electronically.
Bob and Jay, one of the big things for any small business is cash flow. Now, while Apex helps secure against major risks to protect a successful business, cash flow is always a concern. Can you discuss a little bit about the financing arrangements you guys have put together?
Yeah, that's an important piece there. In fact, I think it's the most important piece. Anybody wants to be covered for insurance, but they also don't want to be cash poor in their business.
Correct.
The way we have an arrangement with a premium financing company where they premium finance 90% of the premium with an interest-only note. That interest now runs between 2.09 and 2.7%, depending on their profile, and that's determined by the premium financing company. So, for example, if you've got a client where their Apex premium is $500,000.
I'm sorry, Bob. Let me see if I understand you right. So if I have a premium, I'm going to use big numbers. If I had a premium for my excess coverage of $1 million, it's going to cost me through your finance arrangements only $100,000.
That's right. You premium finance on an interest-only note the other $900,000. That $900,000 there, whatever bank your business banks with, it never leaves. That's your money to do with what you want, whether it's in the business or, investing as you normally would with that money.
Now, when I look at that from an accounting standpoint, do I still get the deduction of the $1 million premium, or do I only get the deduction of the $100,000?
Well, no, your premium's still $1 million.
Wow.
The amount you premium finance is irrelevant. Your premium is your premium.
Okay. Now, who finances? I'm just curious.
We use a group out of Manhattan. It's the Einstein Capital Group. And how it works, Eric, when let's use that $1 million for an example. You've got a client with $1 million premium. They would premium finance the $900,000. They would have to wire or send a check for the $100,000 through our website, and that goes to Randall Quilter. They would not have an interest payment due for 48 months. They would pay 4 interest-only payments. It's 24 months is when the first payment, the premium or the interest payment is due. They would pay 4 interest-only payments during the time it's after their policy is enforced. So let's use an example of 2019, December. They put an Apex Excess and Surplus program together 2 years from now. So December of 2021 is when their first interest-only payment. And then 2024, they're done.
So it's a 5-year term, Bob, you would say?
It is. And what else is unique about Apex, Eric, that's a little different than what most people are used to? It's a return of premium policy. So if you've put that $1 million of premium on December 31st of 2019, and let's say the policy expires December 31st of 2020, after 5 years, you will recoup your money, less expenses, and any claims that you would have received after the 5-year period.
Wow. So now when I think about borrowing money, I think there's always collateral attached. What type of collateral is attached to that $900,000 does the client have to put up?
It's non-collateralized. There are no requirements to collateralize the loan because that does put a hit because they're also trying to get money in other areas for their business. And if they're maxed out on collateral, that can affect them on their business. So we do it without collateral so it doesn't hurt anything else they have working in their business in other areas.
So, Bob, if I understand you right, you guys are insuring companies as an excess insurance supplier. you're doing it on a finance basis, and in your example of $1 million, a client would need only $100,000. You would finance the rest with no collateral, and that could carry out with interest only for a period of 5 years. What would they do after 5 years?
That is correct, Eric. After 5 years, the exit strategy is quite simple. Once they've made their final interest-only payment to the finance company, they would receive a letter and a satisfied note saying you no longer need to make any interest payments and your note has been satisfied. So the note goes away.
What if a client wants to keep going beyond the 5 years? Can they re-up, or how does that work?
Every year that they make a premium payment, let's use for an example that you're $1 million and they want to do it for 4 years. Every year they make a premium payment, the process starts like it does in year one. They pay 10% up front and they premium finance the other 90%. And as the 5 year lapses, the year one premium is going to be satisfied 5 years from now. Year two is 6 years from now. It's always their option at that point. If they still have a need for the insurance, they always have the option to pay another premium.
Wow. Okay. So they could pay premiums throughout the 5 year period if they wanted to also. Just have interest going forward on each time they do it. Okay. All right.
And they're never out more than 10% of their money where the rest is still working for them. And Eric, Jay and I, we have been working in this alternative risk market, and we work with a company. We had about 70 captives under management. Mm-hmm. And one of the big objections we got from the captive owners, depending on where you have that captive established, whether it be North Carolina, Texas, wherever you have your insurance companies domiciled, you can't do anything with that money that state doesn't say you can. You're given an investment policy. So if you want to invest in real estate, that's not going to happen in the captive world. If you want to buy a piece of equipment for your business, that's not going to happen when you own your own insurance company. This way, with the excess and surplus program we have, that money stays in your bank, and it's never, ever, you never have to get approval to do with that money what you want.
You know, and back to capital, Bob, if I remember correctly, on an 831B, the maximum amount is $2.2 million you could put into a captive. That's a lot of money to have tied up.
Not only that, Eric, this is Jay. The hook on the 831B side, as Bob was alluding to, is the capital that you have to come up with. And usually on a premium of that amount of 2.2, in the captive world, you're going to have to capitalize anywhere between 30 and 38% of what your premium is. So, you know, using the $2 million captive premium, the captive owner is going to have to come up with an additional anywhere from $650,000 just to capitalize that in addition to the premium. So it really starts compounding in the captive world, not only from a resource standpoint, but also from, you know, a rules and regulation standpoint as to what you can and can't do as a captive owner in that world. Under the Apex umbrella and under the Apex program, there isn't any of that. So the person stays really in control of their funds and how those are used within their business structure to continue to grow the business during the time they're with Apex and in the programs that we have with them.
You know, what I like too about Apex is the use of Randall and Quilter. It's a real insurance company based out of London versus you trying to have your own insurance company and having to go through all the regulatory requirements and compliance requirements that are involved that are pretty costly. Can you address that?
Yeah, Randall Quilter, they're a big player in the alternative risk market, and they're based out of London. But the Randall Quilter that we use, the office out of Bermuda. Bermuda is one of the it's the reinsurance capital of the world. It's the gold standard for alternative risk, and that's why we use them. We're also tied in with their total assets that Randall and Quilter has. We end up being a larger company thanks to being a part of Randall and Quilter.
This sounds great. I appreciate you guys being on the line.
Hey, anytime we get to share an opportunity we can bring to the clients in their portfolio from an excess and surplus standpoint, it's a win-win. We're excited about the opportunities and where Apex can go.
Bob and Jay, are there any other advantages that you can speak to in regards to the excess surplus that Apex Insurance supplies?
Eric, yes. And again, I'm not an attorney. Jay and I we're the insurance nerds. We do deep dives in risk management and their insurance needs. But you're in California. We've worked with other clients in California, Eric, and one of the concerns that they have addressed to us is the asset protection side of things. When you purchase your policy and you premium finance that note, the entire time that note is in place, those monies are asset protected. Again, I'm not an attorney. It's best if they consult one. But from what we've been told, it's pretty ironclad that your premiums, due to it being insurance premiums, on top of a note being attached to it, that they are being protected by creditors and any other sources that you would be concerned with protecting whatever your business has.
Okay. Wow, that's a big deal here in California.
Yes.
Well, thanks for this episode of Protect, Profit, and Preserve. You can always call me or email me at eb@wait-what.biz, and I can connect you with Bob or Jay if needed to explore this opportunity a little bit deeper for your business. Thank you. Thank you, guys.
Thanks.
Thank you very much.